Okay, so a few administrative items today. As I said, if you're not on a team, you need to make sure you get in a team before you leave the room today. One thing you'll need to do is Stock-Trak. So this is Stock-Trak, which I think I'm logged out of. So let me go back into here. And if you haven't already, you need one of your team members to log into stocktrak.com and create an account. They will need to spend the $29.95 on their credit or debit card and collect the rest of the money from everybody else. Once you've logged in and have an account, choose a team name, and then what will happen is that we have 6 teams in this section. So I'm going to have a total of 27 teams across all my sections. You make sure you register with the link that's on the syllabus. And then in a couple of weeks, based on whatever team name you choose when you register, we'll talk to you about who's in this section because that's who you're competing against for the grade. All right, so you're not going to compete against the other sections, just the ones here, but it's going to lump all 27 teams in through that link into the Stock-Trak account. So what will happen is once you register, it's going to give you $1 million theoretical dollars, and you can buy stocks on margin, so you can buy up to $2 million worth of equity. Right now, the margin rate's pretty low, and every transaction cost I think is like $10 or $12 per trade, so it's pretty negligible if you're trading $1 million. Now, there's a couple restrictions. One is you can't put more than 25% of your original portfolio into a stock. So really, $250,000 is the most you can buy when you get started of any one stock. Right, so you have to buy more than one if you want to do the whole portfolio. You don't have to buy anything. You could stay in cash. Matter of fact, if you stayed in cash last semester, you would have actually finished in 4th place out of 28 teams. Market was bad last semester. So back to trading. On your portfolio, you'll see that there's a lot of options to trade in Stock-Trak. You can trade options, you can trade futures, you can trade commodities, you can trade currencies. They have some swaps, they got some derivatives, they can do day trading. All that's disabled. Okay, so I've disabled it all with the exception of equity, where you can either go long or sell short, or you can buy mutual funds. That's it. Okay, and as I said, it has a day trading option. I've disabled that as well. In addition, for the equities, I've set a minimum price of $3 to either go long or sell short. So no trading in the penny stocks. So you can buy a stock for more than $3 and sell it if it goes down, but you can't buy it again if it's trading for like 30 cents a share. Okay, so essentially you can go short. And so what will happen is once trading opens, I think trading starts on Monday, but basically you go here to stocks. So it's disabled right now, but you basically buy or sell or you short will be one of the other drop downs. It's kind of frozen because it's not enabled yet. You'll put in a ticker symbol and a quantity, and it'll give you a real-time quote. And then you can either buy it as a market order, which means it'll just whatever the price is, you buy it or short it. Or you can also do what's called a limit order. So for example, if Apple today is trading around $100 a share and you want to buy it, but only if it goes down, you can put in a limit order that says buy Apple 97 and then good to cancel. So it won't buy it unless it gets to 97. You could also do that as a stop limit. So for example, sell Apple 97. So that way if it happens to go down, it'll limit your losses. So that way you don't have to be monitoring it every day. So you can use some limit orders as well as some market orders. And so what will happen is that every night, Stock-Trak will then recalculate your portfolio value, and under the My Portfolio section, there'll be a ranking. And as people sign up with your team names, you'll be on this list, and you'll see how you compare to the other teams based on portfolio value and number of trades made. All that matters is where you end up at the end of the semester on your portfolio value. All right? So here's the other thing. You won't be able to see what people bought or sold. You can only see the number of trades they made and their total portfolio value. That's all you're going to be able to see against your peers. And like I said, in a couple weeks, once everybody is signed up, then we'll identify who is in this section, and you'll see who you're actually competing against. But otherwise, I believe between now and Monday, sign up because the first day of trading is Monday of next week. Okay? Questions about Stock-Trak? All right, so a couple of other things. So again, next week, Monday, Wednesday, there is no physical class because the BAT, the Bloomberg Achievement Trust, is being administered in this room on Monday and Wednesday. So if you have not already and want to take it, because we have over 30 people registered for every one of the sections, which is great. We got tremendous turnout, but Bloomberg is going to lock off the BAT at 40 to 42 people because this room is going to fill up. So if you want to take it and you haven't registered, you better register soon because you might get locked out of taking it on campus. So basically, register for Take the BAT. There are 25 computers in this room, and there are going to be 40 to 42 people that can take the BAT in this room during a time, which means many of you will need to use your own computer. My recommendation is to bring a laptop regardless because the computers in this room are unreliable at best. Most of them are 6 years old. In fact, that computer over there just flickers, doesn't really do much. All right, so I'm just saying not all the terminals are fully functional in this room, so you will need to bring, and I would, if I were me, I'd rather use my laptop than one of these machines. But nonetheless, it'll be in this room next Monday and Wednesday. So homework assignments coming up. So homework 1 is going to be made available at the end of this class, which will require Bloomberg, and is going to be due this coming Monday at 10 a.m. for all sections. Okay, you'll submit homework 1 on Elm's Canvas. The only reason why there's nothing for homework 1 today is I didn't want people to do the homework assignment in the middle of class. So basically, but you will need to use the Bloomberg terminals to complete homework 1. It's an EIC assignment. Homework 2 is the Bloomberg certification. Right? So basically, you have to post your Bloomberg certification files to Canvas 1 week from Monday. Okay, so the 22nd, again, by 10 a.m. So back to Bloomberg certification. If you've logged into Bloomberg, go to BU, to go to Bloomberg University, go to the online training videos. Again, watch the 4 core videos. So notice 20 minutes, that's 40. 30 minutes is 70. Call that another 30 minutes. That's about 100 minutes of video. Then take the core exam. Right? Make sure you get 75%. Then watch the equity video, another 30 minutes. Take the equity exam. You'll get 2 PDF files. Right? Then what you'll do is you'll go to Canvas. And under homework 2, once you're done, under the assignments, you will upload those PDFs. Okay? 3 points for the core exam, 1 point for the equity exam, total of 4 points. Again, that is going to be due a week from Monday, 10 a.m. Right? Now, because the BAT is going to be administered next week in class, you'll need to finish your certification outside of class. This lab is generally open from 9 to 5 weekdays. The reason why it's not open beyond that is because when they were setting up this lab with all the equipment, the new Bloomberg terminals, literally as Chuck was in here installing it, somebody walked off with some of the monitors and the keyboards that were left out in the hall. So because this is not a physically monitored with a person room, they leave it closed on the weekends and out of school business hours to prevent theft. It's kind of sad that's the world we live in, but that's why this lab is not open as much as the lab downstairs. The lab downstairs on the first floor actually has somebody in it at all times, so it's open on weekends, and it's generally open 9 to 5, 9 to 6. Okay, so during the BAT, you obviously won't be able to be in here to take it. Tuesday, Thursday, Friday, you can come in here, although I think there's a Friday class in here for Bloomberg certification. But basically, you can come in here, and then the whole week, you can use the lab downstairs. Yes?
What's the room number of the lab downstairs?
I want to say 15, 17, but don't quote me on that. But here's the thing. If you walk down past the elevators, past operations, it's right there on the right.
It's like
So just 1312? 1312. But down the main corridor on the right, just past the elevators, just past the stairs. Okay? Good question. Other questions? All right. And again, if you have questions about some of this, see my TAs. My TAs took this class. They know how to use Bloomberg. They can help you as well. Plus, the person that's manning the lab downstairs knows about Bloomberg as well. So they can help you as you struggle with some of the getting logged on if you have any questions about that. Okay. You probably want to bring headphones to the lab if you're watching the videos. All right. So the last thing we want to talk about today is lecture 2 and homework 1. Right? So we're going to talk about that in just a minute. But I also mentioned we want to talk about sort of current events. So yesterday there was kind of a major company's current events. Apple had their big announcement. I am sure that the guy who was in charge of the video stream was fired today because apparently they had all sorts of trouble getting people to watch it. And from what I read this morning, is it wasn't that their servers were overwhelmed, it's that the guy misconfigured it, whoever set it up for the streaming. So in any event, they had these big announcements. So here's the question. What do you think is going to happen to their stock price? Is now a good time to buy? Should we sell? Should we kind of hold on to it based on what we heard? What do you think? So it's not whether you're going to buy one of the new iPhones. It's what do you think about the stock? Yeah.
Buy it.
All right, why?
It's going to take over a large percentage of the market of the guys who like to have the bigger phones for web browsing.
Okay, so you think the bigger phones are going to help them gain some market share because they'll get some people that otherwise wouldn't have bought the phone because they wanted the bigger Samsungs?
The small phones will.
Okay. Yeah.
I think like you should wait a bit, because right now after the announcement, I think a lot of people have already thought this way. So the price might spike up, even though the actual stuff isn't keep up.
Yeah, we don't really know yet, but as you said, if we look at a current quote one day after the announcement right now, Apple is up about $3 a share. So there's a halo effect to what happened yesterday before the data comes out. So obviously people are somewhat enthusiastic. Yeah.
I think everybody was selling the news yesterday, spike around 104, and then some news article came out. I'm not saying buy everything he buys, but Carl Icahn, they said he's buying shares, more shares than this. I don't know, that's a good sign.
Okay. Well, part of it's going to be what happens. And to be honest with you, I think the wild card to watch is not the watch, because the watch isn't coming out till next year. And there's just going to be, if you're thinking about the short term, so that's what I said, think about your Stock-Trak, what's going to happen in the next 3 months. I think the wild card is going to be the Apple Pay service, the pay service with their new phone. And here's the reason why. At the end of the day, I was reading a news article on the financial press that said during their presentation, one of the slides showed they have 83% of the credit card companies in the U.S. basically behind them, as well as the 3 major processors, American Express, Visa, MasterCard, and then the 6 largest banks. So they got Bank of America, Chase, Wells Fargo, Capital One, I forgot the other 2, but basically that was a coup because the credit card companies themselves had created the ironically named company ISIS a few years ago, which they've actually had to change because of the terrorist group. So I forgot what it's called now. But the point is, they couldn't agree on a standard for their own processors with NFC chips and everything else. And they've been fighting over that standard for a couple of years. And then Google tried to organize them and couldn't get them together. And what's major that happened yesterday is Apple organized them. And the fact that they have the 6 largest issuers of credit cards and the 3 major processors all in agreement on a standard is a big deal because it means that standard is likely to be implemented. I also think that Apple got lucky. And the reason they got lucky is they can thank the data breaches at Target and Home Depot. And by the way, if anybody's seen, the Home Depot hack is worse than the Target hack. So if you've shopped at Home Depot in the last 6 months, get a new card. Right, because they pretty much have all your information. But basically, that is, I think, is working in Apple's favor here because it's not about the convenience to the customer. It's about the security that comes with their Apple Pay service that's really going to matter. And the reason why I think it's important is because the way they've described it is that every time you use your new iPhone, one of the terminals, that basically it's a one-time use credit card number. So basically, when you buy something, it gives a random number to the vendor that can't be used ever again. And that's why I think the credit card companies are lining up behind this. So it's not just giving them the same number over and over and over and over again. It's giving a one-time use number every time you use it. Well, that's going to help with fraud prevention. And this is why this becomes very important. And this is what the article I read. Apple struck a deal that they get a piece of every transaction. So it's like iTunes. So every time you buy and download a song on iTunes, Apple gets a slice. They negotiated a slice of every transaction. And that could be potentially huge, or that could be trivial. Right? And so that's the point. That's where I think the real excitement for Apple shows up. Because if they negotiated a decent sized piece and this actually takes off, then this could be much bigger than iTunes. And it has a lot of growth opportunity for Apple. So it's not the phones that matter to Apple so much as I think the transactions, because banks do a lot of transactions every day. And if they're getting a piece of every transaction you make on your phone, that could be a big deal for Apple. So that's the data point, but nobody talked about how big a slice that was. So that's going to be the key. What's the adoption? What's the size of that slice? That's where you'll see the analysts start to flock to Apple or flock away if that actually gets adopted. Anyways, that's something we should pay attention to in the next few weeks as we think about Apple. But one of the things we can quickly see is that there has been a slight upward revision in quarterly estimates for second quarter 2015 and third quarter 2015 since yesterday. So the profit estimates for Apple, not the revenue estimates, have already started to inch up. And just remember, every time a transaction is processed, it doesn't cost Apple anything. So all those little slices they're getting out of every time you use it, the transaction pay, is just pure profit to Apple. Okay? So unlike iTunes, they got to pay something to the, well, actually they gave away the U2 album for free yesterday. So make sure you get your free U2 album if you didn't get one. Everybody hear about that? So if you have iTunes, U2 they launched a new album. It's free if you have iTunes. You just download it. So anyways, if you're into that, free album. But unlike that, where normally they pay the artist, they don't have to pay the artist. So they just are going to keep pure profit on this. I think that's why you're starting to see some of the inching up of the analyst estimates here. All right, so today is going to be EIC day. And in the interest of time, I'm just going to focus on what's required to do the assignment and assume that you did the readings in the book. So EIC is a framework that stands for E as economy, I industry, C company. And it's really a framework to help us understand the external factors that will influence the value of a stock. And what the data shows is about half of a company's performance is going to be determined by these external factors. Right? So that's why it's very important to do this analysis. So we're going to start out with the concept of E, which is the economy. And what's going to matter here is the idea of what we'll call economic sensitivity. So when the stock market, when the economy changes, what's going to happen to the company's stock? All right? That's the real question we're trying to address with the E. Okay? So here's how we're going to use Bloomberg to help us with these questions. So in Bloomberg, one of the things that you can do is start typing in short codes. Right? So once you've logged in, and this is why you're getting certified, Bloomberg was created in the early 80s before the world of the mouse and the graphical user interface. So it's just a legacy where you can still type in text off of a keyboard to run the system. Right? So they have these short codes, 2 to 4 digits. And in this case, one of the short codes, if you start typing EC, at the top of the list, it'll show you the functions. In the middle of the list, the securities. But EC is the economic data. And so, for example, if you type in EC, you can go to ECST, and that will get you World Economic Statistics. So, for example, I can get across all these data points all this economic data. So there's GDP for the U.S., here's consumer price data for the U.S., here's the labor market and unemployment data for the U.S. So every one of these things that you hear reported, they're right here at your fingertips in Bloomberg in real time. Okay, and that's, again, you get this under economic statistics. If you want to switch countries, you can look at it for any country in the world. Okay, so again, it's just a very handy way of getting your world economic data here. In addition, if you go to EC, and then you can go to the economic matrix, then it'll just give you like a quick view of all the major countries in the world and things like GDP, consumer price index, unemployment, central bank interest rates, etc. So again, very good information. Now, two codes that are going to be of particular interest to us this semester. I got to remember what they are. ECSU is going to be one of them. Actually, I'll do that one next. Was it ECFC? Economic forecast. I'm going to start there. And I'm recording this so you can actually see these on screen. But here's the point. The EC economic forecast is literally that. We talked last week about how the analysts create consensus forecasts for the earnings of companies. Well, the economists create consensus forecasts for the data for countries. And Bloomberg aggregates the consensus of the economists. So this is for the United States, and again, you can choose whatever country you want or region you want and see not only historical data, but you can see forecast data. So in this case, for GDP, last year 2.2% US, next year 2014 expected to be 2.1%, 2015 3%, 2016 2.9%. Unemployment by December 6.2, next year 5.7, year after that 5.4. This is kind of the consensus. So one of the things that we should be thinking about is that in good economic times, then what should happen is the market should do better, and in bad economic times, the market should do worse. So this gives us a sense of the economies, and we're dealing mainly with U.S. companies this semester, of U.S. companies. So that's the idea of here. We can quickly see for any economy what the economic outlook looks like. But here's the more important screen. It's called ECSU. Up here. EC, Economic Surprise Index. So what Bloomberg has done is they've created this thing called the Surprise Index. And they've taken 54 economic indicators and they put them all on one screen. And if you check the box to group by sector, you can actually see it by sector as opposed to just unfiltered. And I checked the box to group by sector. Right? Now, here's the thing. This shows housing data, industrial data, labor market data, personal spending data, retail information, and all the surveys, like consumer confidence surveys. Matter of fact, last semester, I made the students go to the conference board to look up the leading economic index from the conference board. Well, there it is. It's one of the indicators in real time. And then here's the thing. What they do, take the leading economic index, is this is when it was released. They know the expectation for every one of these indicators based on the economist consensus, and then they have what they call the surprise, which is the variance versus the expectation. Green being positive surprise, red being negative surprise. Then they have this little chart of what happened to the S&P 500 after it was released within that first 30-minute period of time. So they can look at the reaction, right? So you can see the historical reaction when that number was released, generally available in the market, and then what happened to the S&P 500 index tick by tick right thereafter. But what's more, I think, interesting is they then took an index of these 54 indicators and they charted it against the S&P 500 change over time. So when you see red, these are negative surprises across all those economic indicators, and green are positive surprises. So here's the point. GDP might be expected to be 3%. If GDP comes in at 2.5%, that's still good. The economy is growing. But the problem is, as we talked about before, if people expected it to be 3, they priced it as if it was going to be 3%, and when it came in below, the stock market's going to fall. So what matters more is not the economic data itself, but how we do against expectation. This screen in Bloomberg is showing you real-time expectations and real-time data that's against all those economic factors against those expectations and what's happening with the stock prices. And this is the interesting thing over the last 5 years, which is of observable data, the orange line is the S&P 500 index, and you see it's relatively correlated to the economic surprises. Like when sentiment was getting worse, the market was going down. When sentiment was getting better, the market's going up, right? Relative to expectations. So here's the point. Assumption, based on this observed data. We believe, or we will believe, that the stock market, think the S&P 500 in the US, is tied to the economy. So what we care about is what's happening to people's expectation about the economy is going to drive the stock market up or down. So therefore, on an individualized stock basis, how is my stock tied to the S&P 500? Is there an indicator that shows me the answer to that question? Is there an indicator that shows me how an individual stock is tied to the S&P 500? Yeah, beta. So that's what we're going to use as our proxy for economic sensitivity of an individual stock. So let's take McDonald's. So I start typing in a company's name or ticker symbol. In the middle of the screen, it'll show me the filtered securities, in this case McDonald's. And then once I'm on a company, I could literally just type beta, B-E-T-A. And there's a real-time beta of McDonald's, 2 years weekly default. Now, I went to Wharton a long time ago, and back then, we didn't have all these cool tools. We used to get what were called the Bera Beta book, and every quarter it would come out. And when we had assignments, we were competitive. Somebody would go to the library and they'd steal it. So nobody else could do well because they'd either hide it or they'd rip the pages out. It was a brutal, vicious place. But in any event, I was biased towards 5-year betas because that's what we used to look at in the Bera book. It was always 5-year betas. So there's arguments for different terms, and I don't want to get into that. I'm just kind of used to looking at 5-year betas, so I'm just going to mandate for this class 5-year betas is what we care about. The reason that matters is Bloomberg defaults to 2 years. So we got to switch to a 5-year beta, which means I come here to my default date, and I switch this to 09, hit enter or go, and I now have a 5-year beta for McDonald's. All right. Now, specifically, what it's going to do is it's going to regress the security against the underlying index that the security is in. Since we're dealing with U.S. companies, it'll deal with the S&P 500. Now, last night there was a news article that the chairman of Banco Santander has passed away, and that means there's probably activity in Santander stock today. But the interesting thing is when I work with Santander, Santander is like the second or third largest company in Spain, and Spain has a very small stock index which doesn't have too many companies in it. So the problem is when you look at Spain's beta to Santander, it's like regressing against yourself, right? So the problem is you really wouldn't want to regress in a small country with not a lot of stocks, an individual stock, particularly the biggest ones in the country, against itself. So you might want to switch an index to like the Morgan Stanley World Index, ticker MXWO. But here's the point. For U.S. companies, the S&P 500 is pretty broad, so we usually use that by default. In your homework assignment, you won't have to change any of this. I'm just kind of giving you more of an FYI. But here's the point. Bloomberg gives you a raw beta, and Bloomberg gives you an adjusted beta over here on the right. The raw beta is just that. It's the slope of the trend line. Okay, that's the actual raw beta. The adjusted beta is a statistical argument because statisticians believe in regression to the mean, so they put in a regression coefficient with the beta. The way Bloomberg handles the regression coefficient is they take 2/3 of the raw and 1, and then they do a weighted average. So they just basically take the raw beta and they move it 1/3 closer to the mean. All right? That's called the adjusted beta. So if you do, for example, CAPM in Bloomberg, they'll use the adjusted beta by default. For our purposes, since what I care about is economic sensitivity, I'm going to suggest that we use the raw. Because what I really care about is when the market changes, how's my stock moving, actually, over the last 5 years? That's the raw beta. So for McDonald's, that number, 0.475. What does that mean? To have a raw beta of 0.475.
Like for every like dollar that the market goes up, it goes up 0.47.
Yeah, I'd say more percent. But yeah, if the market goes up 1%,
Yeah.
McDonald's goes up 0.475%. And if the market goes down 1%,
It goes down 0.47.
that's right. So it's not going to go up nearly as fast. It's not going to go down nearly as fast. Right? So what does that mean in terms of risk?
It's low risk.
It's a lower risk than the average stock. Everybody see that? So somebody might consider McDonald's a safety stock. Now let's just think about this intuitively. Why might McDonald's have a low beta intuitively?
They sell inferior goods, so
Inferior? Really? Okay. I'm just curious.
well, like in bad economic times, people still eat there, and still like they're not going to collapse basically. So.
Okay. But why don't they do so well in good economic times?
Because people will go eat at like fancier restaurants if you have lots of money.
Yeah, I could buy that argument. So basically, at McDonald's, when economic times are tough, the dollar menu looks more attractive. When economic times are good, you move up to Chipotle or something like that, fast casual. So, but that's the point. McDonald's is going to be a relatively steady performer. This is going to be important when we forecast cash flows, because eventually we're going to have to forecast companies, and companies that have these relatively low betas can probably have almost like a trend line forecast as opposed to a much volatile line forecast. So that's going to also influence our forecast. But by the way, McDonald's was in the news last week. What happened to McDonald's? They actually reported terrible sales. Was it because of bad economic activity in the rest of the world? It was actually attributed to poor execution in China. That they had some sort of issue with one of their suppliers in China, and it really hurt them pretty badly. And their same-store sales were way down. And it was completely unexpected, and their revenue was way down. But that would be the point. I wouldn't expect that McDonald's is going to have a big jump in their same-store sales because of economic activity because they have a low beta. If they have a big jump in their sales up or down, it's probably because of something else. And that's exactly what happened to McDonald's. It was the something else. They had some execution issues which really hurt them last quarter. So here's the point. What about Royal Caribbean Cruise Lines? Second largest cruise line operator in the world. We're going to look at their beta in a second, but what do you think? Is it going to be high or low?
High.
Why? Why might it be high? Yeah, it's a little bit more a luxury good. So generally, we don't go and experience luxury when we're in a recession, and we tend to spend more on travel and leisure when we have good times. So we'd probably expect them to have a high beta, right? Well, let's see. Here's Royal Caribbean, U.S. equity. Then I type in beta, and then I go to by 5 years, 09, hit enter or go. And over the last 5 years, beta almost 2, 1.974. So this is what would be expected, but nonetheless, I could say they're much more economically sensitive. So when I forecast Royal Caribbean eventually, I probably don't want to forecast a straight line for them as well. They're going to probably be a much more cyclical company, and that should inform the way that my forecast would actually be delivered. Now, here's the thing. As part of your homework exercise, I'm going to give you a company. It won't be these two. It'll be another one. And you're going to have to go get their beta, and you're going to have to explain whether or not they're economically sensitive. You're going to have a screenshot to back it up. Because in this class, you actually have to show with data your assumptions. Okay, so you can't just state things. There's no just asserting things. You've got to have data to back it up. So you're going to have to upload a screenshot of your 5-year beta. So here's how you do it very easily. In the upper right-hand corner of just about every screen in Bloomberg are these icons. And one of the icons, if you hover over it, says Export. And if you click on the Export button, one of the options is to save screen as file. So literally it'll take a screenshot and it'll save it as a GIF file somewhere that you put it. You can also grab the screen, which is basically copy it and then paste it somewhere. But I think it's just easier to save the screen as a file. So you click on Save Screen as a File, and then save it somewhere, hard drive, thumb drive, whatever, because you're going to have to upload this as part of your assignment. Now, the convention that I use to save the name is I call it the ticker symbol, RCL, I put a dash, and then the 4-digit Bloomberg code beta. All right, you can name it whatever you want, but when I save things, just so you have a little bit of a roadmap, I'll give you the name of the company and what the symbol was in Bloomberg to get to that screen. So that way it'll help you a little bit. But nonetheless, I save it. And I'd already created one of the earlier sections. So I come back here, I go to my downloads folder, and there is the screenshot that we just took. Right? Now, one thing about it, just so you know, at the bottom of every screenshot is the serial number, time and date stamp of the machine when you took it. So you really shouldn't be using other people's time and date stamps and unique serial numbers, because we'll know that if you turn in somebody else's homework, it wasn't your own. Okay, that's how we catch you. So don't do it. When I say individual assignment, you should each be individually taking the screenshots. Don't trade them, because we'll know that they were traded. We can track it back to who originally traded it. Makes it really easy to go to the honor console. XFs are bad on your transcript. All right, so back to this. This is the E section of the EIC. The next thing we're going to want to do is the I, which is the industry analysis. Now, in this class, we're going to define industry attractiveness very specifically. It's not subjective. It's not, oh, I think this is a good industry. It's objective. It's observable. And specifically, this is a finance class, so an attractive industry is one where you make money. Specifically, create value or have positive NPV. The way you have positive NPV, IRR greater than discount rate. Translation, ROIC greater than WACC. That is an attractive industry. An unattractive industry, negative NPV, ROIC less than WACC. That's what we're calling spread. So the industry attractiveness is based on the observable industry spread. And it's not the historical spread, it's the current spread. That's what we're going to care about. Okay? And the future spread is the valuation class. Right? So this is important because you can't let your biases get in the way of your view of industry performance. Right? So I was teaching this class a couple semesters ago in the part-time MBA program, and one student just could not get over the fact that airlines are a terrible business. Right? And one of the reasons he couldn't get over it, beyond his own personal experience, was that the book had this graphic in it. And he'd read the book, and what it showed is the ROIC performance and then the variance of different industries over a very long period of time, and the airlines were the worst performing industry historically. And based on his own point of view, based on a Harvard Business School case study he had done in a previous class, and this data, he believed that airlines were a terrible business. But if you actually looked at the airline industry today, the airlines are actually doing pretty well. Right? So historically, yes, they've been a terrible business. But today, the airlines are doing pretty well. Matter of fact, last week, probably for political purposes, the Congress announced they're investigating the airlines for making too much money. Right? Because people are complaining about all the fees that they're charging, and their fees are leading to record profits for the airlines. Right? But that's the point. The fees are making the airlines a lot of money right now. It's actually a much more attractive industry than it was historically based on the observable data today. So what we're going to care about is what is the industry ROIC? What is the industry WACC? I'm going to show you how we get that data. So we're going to go to Bloomberg, and I'll go back to McDonald's. And then what I'm going to do is I'm going to use a section called RV, which stands for relative value, relative valuation, which allows me to very quickly compare one company against a bunch of its peers. Okay? So I'm going to go to the RV section, and this is McDonald's against its publicly traded peers. Now, by default, Bloomberg is going to actually load in the GICS peers. Right? And GICS is the Global Industry Classification Service. So basically, the government standard classifications for companies, they put you in these buckets, and then these are the buckets that are just standardized. And You also could use this general industry classification. Maybe it's general industry classification, whatever it is. It's a standard industry classification. And then you can do it by, in this case, country of domicile. So since McDonald's is a U.S. company, it would show it against its U.S. peers. If I wanted to go global, I could look at the global peers. I could look at peers in Europe, Asia, whatever. By default, for this simple exercise, we're going to use the U.S. peers. So country of domicile for the company that I give you. And then here's the other thing. Instead of the GICS classification, we're going to use the proprietary Bloomberg comps, stands for comparables. So under comp source, make sure you change this to Bloomberg comps. Okay? The reason why is the Bloomberg comps is a curated list. Right? So the default list is just the government standard classification. The Bloomberg comps is somebody went through at Bloomberg and they said, we don't think that this is the right list. We think these companies should be subtracted and these companies should be added based on our view of what the analysts seem to actually be tracking about their peers. So the Bloomberg list is probably a more reasonable list that Wall Street would be looking at. So we're going to use the Bloomberg list. Now, even if you choose the Bloomberg list, you don't have to use the Bloomberg list in the future. For this homework assignment, you do. But in the future, you can come down here, edit, and then you can decide to get rid of companies by unchecking them or adding them by just typing in their symbols here. Create your own custom lists. But for purposes of this assignment, we want to use the Bloomberg peers in the U.S. for whatever company I give. McDonald's is the working example. By the way, up top, actions, I can hide the top section. So this is McDonald's against some random set of numbers. Now, these are some predefined templates across the top. And then I go way over here and I go to custom. Custom allows me to choose what variables I want to compare against. So we're going to go to custom. And what I care about is two pieces of data. Number one, I care about the ROIC. Number two, I care about the WACC. So I come in here to add column and I type in ROIC and there's return on invested capital. So hit enter, select it, and then it'll ask me which period of ROIC do I want, because I can actually go back historically and look at a historical ROIC. Well, the period that I'm going to care about in my template, it's not the customized period, it's the latest year, right, as opposed to the latest calendar year. And the difference, and the reason why we're using the latest year is it's the last annualized year of the company. Not everybody does a December 31st close. All right, so by doing latest year, it's the latest fiscal year for the company. So I choose latest year, I hit enter or go, and there it is. ROIC:Y for the latest year. All right. The reason why this is also important is when I save this template, anytime I load it, it will always give me the latest year. So if I go a year from now and I load this template again, it'll give me the 2014 data. Okay, right now it's giving me the 2013 data because it always says pull the most recent annualized data. Then I come back to add column and I type in WACC. In Bloomberg, there is only one WACC. It is the current WACC on this screen. So there's the WACC. So current WACC against latest ROIC, there's my spread for the publicly traded companies that are McDonald's Bloomberg peers. Essentially, I now have an industry with $28 billion of revenue here. All right, so next I go to select stats, and I can choose some stats to do against this list. I don't do the average. We're going to choose the market cap weighted average. And the reason we're going to do the market cap weighted average is we do not want a small company to distort the average. So we're going to do an average based on the size of the company, based on their market cap. So again, market cap weighted average, hit update, and there it is across the top. So here's what I know about the restaurant business that McDonald's peers competes in, basically fast food and fast casual, is the average ROIC is 21.63%, the average WACC 7.85. Is this an attractive industry? Very. Okay, so I could quickly see that this is an attractive industry based on observable data. Now, I'm missing private companies, right? And the two best fast food private companies are not on this list. Anybody know who they are? Number 1 and 2? You can't even argue. It's indisputable who the two best fast food private companies are. West Coast, In-N-Out. If you don't know what that is, talk to your West Coast friends. And then Southeast. So their founder just died.
Chick-fil-A.
Chick-fil-A. Okay? So I'm just telling you, they're not on this list. I know it's tragic, but other than that, these are the publicly traded companies. So back to this. Is this an attractive industry? Yes. That's going to be our definition spread for the industry as to whether or not it's attractive. Finally, save the template. Click on the Save As button, name the template. I think you'd have up to 10 characters in the name. So I might call this 443 Spread or something like that. Hit Save. Now I'd saved it in the previous class, so it's going to overwrite it. Hit OK, and then it'll create a little button on my screen with the Save template. So every time I click on the button, it'll load this template. So here's the deal. I go to Southwest. Love is their ticker symbol. I go to RV. I go to Bloomberg Peers. I go to Custom. Click on my template. There it is. The one thing that's annoying is it doesn't save the stats that I chose. So I have to go back to Select Stats and Market Cap Weighted Average again. Is the airline industry attractive? Not as much. Is the airline industry attractive? If we define it as spread, yes. Now, I agree, not as attractive as fast food, but it is attractive nonetheless. Everybody see that?
There's one problem though. Like,
There's a problem?
these caps have no ROIC.
That's right, because one is in bankruptcy right now, American, and I think Delta was losing money. So, yeah, there's some issues when it's not available. So I don't disagree with you, but it's just kind of a quick screen that we're going to do. I probably wouldn't use the airlines for a homework assignment. So good point. So let's go back and look at fast food, or fast casual. So RV, spread, select stats, market cap, make sure I'm looking at the Bloomberg peers. By the way, actions, I can hide the top if I want to get it all on one screen. And then finally, export save screen as file. This is the second screenshot you're going to have to take. So I'll call this MCDRV. So you're going to need two screenshots for your homework assignment. You're going to need the beta and you're going to need the RV. Okay? On a different company than McDonald's. But back to this. Competitive advantage. In this class, we're going to define competitive advantage very specifically. And the way we're going to define it is relative performance to your peers. Okay? So it's not, are you creating value or are you destroying value? It's, are you outperforming your peers? That is competitive advantage. All right? So that's the point. Everyone in this room is very smart. But by definition, half of you are not as smart as the other half. Now, I'm not going to go there beyond making that statement. That's not a fun statement that we want to get into, but it is a truthful statement mathematically. Same thing is true in the real world when we evaluate companies. Like, this industry is a great industry, but by definition, most of the players are doing well and some of the players are not. So we have to define which ones are doing better on a relative basis. Okay? So that's competitive advantage. And what I want you to start to think about when we evaluate companies is that basically, is the company doing well because they're in a good industry, or is the company doing well because they're doing really well against their peers? And I want to start making that determination. So let's talk about Mickey D's. Does McDonald's have competitive advantage using the relative definition?
Not really.
What's the industry ROIC? What's McDonald's ROIC? Are they outperforming the industry ROIC? Let's look at it a different way. What's the industry spread? ROIC minus WACC, approximately. Call it 13, 14, depending how you round. What's McDonald's industry spread? 13, 14. Are they really doing better than the industry? Not really. So one could make an argument that McDonald's, now again, embedded in this list are what we would call fast casual, not pure fast food. But as an investor, that's the way I'm choosing. I'm choosing between McDonald's and Panera. I'm not just choosing between McDonald's and Burger King. But nonetheless, McDonald's is doing well because they're in a good industry, not necessarily because they're the best company in the industry. Does everybody see that? Who has competitive advantage? And it could be more than one. Domino's kind of jumps out at you. All right? Anybody know why?
They reinvented themselves.
It's not the reinvention. I'll give the same story I gave earlier, even though it's on YouTube. I think the statute of limitations is probably passed. But when I was 17 years old, I illegally delivered pizza for Domino's, right? Because basically the franchisor went to my high school and just recruited a bunch of youngins to basically deliver pizzas. And it was great because back in the early 1980s, when I was, closer to your age, I'm getting old now, but basically minimum wage was like $3.35 an hour, and I was making like $12 an hour in high school. And the reason why is because you got tips and they paid you for mileage. So it was great, right? But technically you had to be 18 years old, and I started working there when I was 17. Plus they had the 30-minute guarantee. So we were driving like crazy people to make that 30-minute guarantee, because otherwise you got the pizza for free. And back then. And so basically you had to be there in 30 minutes. There's a lot of pressure. Yeah.
Random question: was that when the Noid was around?
I don't remember that. I don't remember when the Noid was. It could have been. But here's the point. The reason why they were able to do this was because, and that was the key word, it was a franchisee. It was a renegade franchisee who was not really following and enforcing company policy that you had to hire people that were minimum 18 years old. And that's where I learned very quickly that McDonald's is a bunch of franchisors, and it's almost 100% franchised. Domino's. Domino's is almost 100% franchisees. So that's the point. Why is Domino's, the publicly traded parent, doing so well? They don't own any of the stores. They don't own any of the equipment. They don't have to pay any of the people. All they're doing is collecting the licensing fees and basically marketing and branding that, and they're just like a reservation system for online orders today. That's why they have a phenomenal ROIC. The franchisees themselves are not making nearly this money, but that was the point. That's the way they set up. Now, what's interesting is McDonald's has some franchisees. McDonald's also has a bunch of company-owned stores. And so if you actually look at McDonald's, it's a mix of both. All right? They're doing well, but not nearly as well as somebody that's almost 100% franchise. What about Burger King? They own most of their stores. So here's some insight into, I don't have anything other than this speculation, but why might Warren Buffett and 3G Capital be interested in Burger King beyond the taxes?
Franchise.
What do you think they're going to start doing? They're going to start franchising it. It's an easy money, because what I see is, hey, if I start looking anywhere close to McDonald's, I can take an underperformer and suddenly just get me to average and think about all the upside there and all the cash that I can take out by selling a bunch of franchises. And I have to improve the performance of the stores that do this. So I'm not saying that's the rationale they did it, but I'd be strongly surprised if that wasn't part of their business case for why they bought them in private equity. It's not just about moving the tax address. It's also about relative performance to their peers, and they're underperforming, but they're probably not just poorly run. There's probably some execution issues. I think there's probably some easy money there to be made. And that's what the private equity firms are probably looking at. But again, I'm just saying, that aside, does Burger King have competitive advantage? No, clearly not. What about Papa John's? Competitive advantage? Yeah, it looks that way. What about Texas Roadhouse? No? But they're making 13%.
Well, the industry has it.
But the industry's making 20, 21. See, that's the point. Is Texas Roadhouse creating value based on this data in this period of time? Yes. But are they really showing competitive advantage while creating value? No. So what I'd say is they're in a good place because they're in a good industry. But they're not one of the better run companies in that industry. That's the way I want you to start thinking about this. Does that make sense? Okay. So here's the point. Once you've identified and taken the screenshot, whether they have competitive advantage and whether or not it's a good industry, you're going to write this up. Okay? But then you got to give a rationale. Why is this such a good industry? So that goes back to Porter 5 forces. So what you're going to have to do is you're going to have to do a 5 forces assessment. There's the 5 forces for those of you who remember them. And you have to write up using the 5 forces assessment why it's a good or bad industry. Explain using the 5 forces. Okay, that's going to be part of your assignment. All right? Now, for the industry that I give you, you might not know a lot about that industry. So to help you, remember this is a real world class. We're using complete real world data here. You can go to Canvas. The last link on Canvas is VBIC. If you go to VBIC, you go to the industry tab, there's a data source called IBIS World. IBIS World is industry research reports, okay, for US and global companies. You type in the company or industry name. In this case, I'll type in McDonald's, hit enter, and it'll show me all the industry reports that McDonald's is in. Now, obviously, we're probably not talking about cereal, donut shops, tax preparation franchisees. Why they'd be in that one, I have no idea. But fast food is probably the right industry report. I click on fast food, there's an entire 30-odd page PDF downloadable industry report where they've basically done a 5 forces analysis. So you're welcome to reference the data. Don't plagiarize, reference, but under here, an industry outlook is pretty much where they've kind of talked about this. All right. By the way, later when you go to key stats, you'll also see that they do things like forecast industry revenue, forecast industry profitability. So that could be useful information for future exercises as well. But nonetheless, this will help you as you work on this assignment. Okay. Final part. I want you to predict the future. So, just as a quick example. This data, and I don't want it to confuse you, comes from your reading in the book this week. And what McKinsey did is they looked at about 40 historical years of data and they ranked different industries based on historical ROIC over a long period of time. I don't want you to confuse it with this assignment because this assignment's about observable data for today, not how they've done in the past, right? But notice, what is the top industry historically based on this 40-year time horizon McKinsey looked at? Pharmaceuticals. Thinking in context of the 5 forces, why might pharmaceuticals have done so well historically?
Because of the patents.
I think the number one reason is patents, which goes into which of the forces?
Supply of power.
Suppliers.
Threat of new entry.
I might call it, you could call it barriers to entry. You could also say it limits buyer power because it limits your choice. You could also say that it limits rivalry, so it could go across several of these. But I think you've identified, I think, the most important reason why the pharmaceuticals make money is they're virtual monopolies when they have patent protection. What's ironic is the pharmaceutical companies today only have 10% of their drugs that are sold under patent protection. 90% are generic, yet many of them are still reporting record profits because of the ridiculous prices on that 10%. Right? And the fact that even as the government has been clamping down as they've tried to increase generics, we've gone from 80% generic to 90% generic, yet their margins have actually improved because the 10% they have left, they're charging even more for. Because they know that if you have cancer, you're going to pay whatever it costs to get that cancer drug, and they charge for it accordingly. So they exercise that power. Now, if you're a pharmaceutical firm, and I work for some of them, it's not like they're saying that, hey, we're not just doing this because we want to take advantage of people. Like, there's a lot of research, And the statistics for pharma are horrible. 10 years of $1.3 billion of R&D with only a 5% chance of success. So they need a pot of gold at the end of the rainbow, or else it doesn't really make sense to make these long bets. All right? But it's hard to explain that to the average person. When you walk into the Walgreens, you get the sticker shock for the price of the drugs. But here's the point. That's one of the reasons why the pharmas are relatively profitable. Look at the bottom of this list. What's the worst performing company over this 40-year period? Performing industry? Airlines. Why are the airlines doing well today where they haven't been doing so well historically? Yeah. What's happened to competition in the airline industry?
It's gone
Yeah, we've seen through consolidation, we're down to 4 major airlines that control over 80% of all passengers. And so you just don't have a lot of choice. Matter of fact, I think I told you I'm flying to Australia. You know how much my ticket's going to cost to go to Australia? $14,000. Now, they're flying me business class, thank God. It's a 15-hour flight from LA to Sydney. So I get one of those little lie flat things. But, I mean, I could buy a car. I could, I could lease a pretty nice condo for a year for that 15-hour flight. That's there and back. But in any event, but that's the point, because there's not a lot of choice. And it's peak season in Australia for whatever reason. So it's ridiculous, but they can charge that because there's not a lot of choice. And there's not that many seats on the plane. So it's all supply and demand. But here's the other reason why airlines are making more money. It's called fees. Is that airlines now charge huge fees as opposed to the fares on the average flight. And that's actually what has hurt Southwest. If you think about the Southwest data that I showed you, Southwest isn't performing very well right now because Southwest doesn't charge fees. You know what the number one performing airline is by ROIC? It's not US Air, which is now American. Who charges fees the most? The most fees of any airline? Spirit. Love them or hate them, and apparently we don't like them, but we still fly them, which is the ironic part. But if you go, and I'll look at Southwest as an example, and you look at the RV section, and we look at the custom screen that we just did, you'll see that Spirit actually has the highest ROIC of any airline, where Southwest only earns 6% and has a negative spread. And what started to happen a few years ago is now the airlines make more than half of their profits based on the fees they charge. And Southwest decided not to charge fees. So believe it or not, that, which gets them great customer satisfaction ratings and has made them the number one carrier by volume, has killed their stock price because they're not charging fees. And the airline that we love to hate and still fly is the one that's gouging us, yet they're making lots of money because we buy based on the fare, not based on the fee. And what happens is, even if you fly and you pay the fees, you still shop on the fare next time without the fee because we don't have good information about the fees. And that's actually one of the things the government is trying to change right now, that the airline lobby is fighting against, is to get transparency on the fees so you actually know what you're really going to pay when you fly the flight. And the airlines don't want you to see that because that's how they're making a lot of money. But that's the point. The industry changes. So here's the long story short. The final part of your homework assignment is you're going to do the RV screen. You're going to say whether the industry is attractive. You're going to do a 5 forces explaining why the industry is attractive or not that I give you. Then you're going to look into your crystal ball and you're going to tell me whether the industry is going to be more, less, or the same attractiveness 5 years from now. Now, I can't ask you to give me a specific prediction on ROIC or spread in 5 years. So what I'm going to ask you to do is give me a prediction on the 5 forces. So basically, are the 5 forces industry structure that you define today going to change in 5 years? Because if the industry structure stays the same in 5 years, then the industry spread's going to stay about the same in 5 years. If the industry forces are getting more favorable for the industry, then the industry should be more profitable in 5 years. If the industry forces are getting worse, the spread in the industry should get worse. So what I really want you to do is predict the change in the 5 forces 5 years and infer what that would mean to the spread of the industry. So it's not precise for the numbers, but it's directional. And this is laying the groundwork so that when, again, we forecast cash flows for the valuations, we're going to essentially be forecasting ROICs, and this will help us make a check on which way those ROICs should be forecast. So is the airline industry, if that were the industry, going to get the same, better, or worse? And why? And that's what you're going to be writing up. So beta screenshot, economic justification, industry RV screenshot, current 5 forces, change in 5 forces, competitive advantage, yes or no. That's homework 1. Okay? That's due by 10 a.m. along with both screenshots that you'll individually have to take. Monday 10 a.m. plus the write-up. A week from Monday will be the Bloomberg certification, which will be our next physical class. Okay? Otherwise, have a good day.
Yeah,
I'm about to post the instructions.